Good day. Welcome to another section of A.E Accounting tutorials. We are continuing our series on partnership accounts. But this time our focus is going to be on the final accounts of partnership business. In our previous video, we look at the various components of the final account of partnership business. We talked about the income statement, the profit or loss appropriation account, and the statement of financial position. But before we proceed to look into details of these three accounts, I will encourage you to subscribe to this channel, turn on the notification bell so that anytime I upload any new video, you will get notified on your devices. Thank you. So the first final account is the income statement. Two, the profit and loss appropriation account. And three, statement of financial position. All right. So we are going to look at how we prepare this account. However, the preparation of the income statement of a sole trader is not different from that of the sole proprietorship. So you can refer to my videos on the preparation of an income statement for a sole trader. It is actually the same. Is that okay? So we are not going to look at the format of this. But the preparation of the profit or loss appropriation account is quite different. Is that okay? For a sole trader, profit or loss is not shared up between partners. It is only the sole trader who enjoy the profit alone. But in the case of partnership business, the profit or loss is being shared between the partners based on the profit or loss agreed ratio. However, it is the profit and loss appropriation account that is being used to appropriate or share the profit or loss ascertained from the income statement between the partners. Is that okay? But mind you that there is certain adjustment that will be made on the net profit or loss ascertained from the income statement, and that adjustment is going to be taken care of in the profit and loss appropriation account. Is that okay? And the preparation of we will be looking at the format of the profit and loss appropriation account. But for the statement of financial position, its preparation over here, that is the partnership business and that of sole trader, it is not different. The only difference is that how we present the finance by column. For a sole trader, what we do is that under the finance by, that is for the case of a sole trader, we always have our capital, then we add net profit or loss. Net profit. Then if there is any drawings, then we take it out. Is that okay? So this is what we do in the case of a sole trader. But for partnership, the presentation is quite different. Because the partners are two or more, what we do is that we normally have the capital account balances for the individual partners and the current account balances for the individual partners. So for the case of partnership, this is what we do. So we have the capital account balance, that is the balance brought down, maybe partner A and partner B. So this is what we do. Then we have the total of the capital account and probably the current account balance for B. So partner A and partner B. Then we bring the total. So this total will be here, this one will be here, to get the total capital balances. Is that okay? Alright. However, this capital account balance and the current account balances, there are certain adjustments that have been made on them. Is that okay? And because of the adjustment, we will prepare the capital account and the current account of the individual partners to actually ascertain their balances. So I will show you how we prepare the current account and the capital account of the partners. Is that okay? But it all depends on the type of the capital account the partnership business is operating. Some may operate a fixed capital account, some may operate a fluctuating capital account. But before that, let's stick with how we prepare the profit or loss operation account. Let's look at the format. After that, then we look at that of the preparation of the current account and the capital account of the partners. Is that okay? Profit and loss appropriation account. So let me use Ghana cedi as my currency. Is that okay? This profit and loss appropriation account, it is prepared to share the profit or loss generated from the income statement. Is that okay? So because we are going to share the profit ascertained from the income statement, we begin with the profit. That is the net profit. Okay, so we have the net profit or loss reported. That is the net profit or loss reported from the income statement. Is that okay? So we bring it here. Okay, the dynamics of this account, it is just very simple. Is that okay? In the preparation of the profit and loss appropriation account, all charges against partners and all entitlements to partners are actually recognized in this account. Is that okay? So what we do is that all charges against partners, they will be added to the net profit or loss reported. Is that okay? So all charges against partners, that is any charges that the individual partners need to pay to the partnership business as a whole, will be added to the net profit or loss that is being reported. Is that okay? And all entitlements to partners will be subtracted from the profit and loss appropriation account. Is that okay? That is all payments that's supposed to be made to the individual partners. We will subtract it from the profit or loss appropriation account. So basically, this is the dynamics. Is that okay? So let's first of all look at the charges against partners. Okay. So the first charges I would like to talk about is interest on drawings. Is that okay? So interest on drawings. Interest on drawings. So that is when any of the partner make drawings from the partnership business and they decided to charge an interest on the drawings. The individual partners is going to pay the interest to the partnership business as a whole. Because of that, we are going to add it to the net profit or loss reported. So we assume that we have partner A and partner B. Is that okay? So for partner A and partner B, I can even bring, okay, let me bring it here. So this is the interest on drawings. We add the two, we bring it to this column, then we add it to the net profit. So we assume that all charges against partners is the interest on drawings, and we've added it. So let's try to think of some of the entitlements to partners. That is where the partnership business is going to pay to them. So we are going to less it. So I may say less distribution. Is that okay? So less distribution. So we less distribution. That is interest on capital account. Let's say we have also capital partner A and partner B. So the total is over here. Then maybe we have interest on current account. Is that okay? Interest on current account. Let's say this time it is only partner A. Let's say partner salaries. Okay, so salary. The salary may be only partner B, but both partners can also receive salaries. Is that okay? So we bring it here. Is that okay? So this is the total of the entitlement to we assume that this are the total of the entitlement to partners. Is that okay? So we sum it up. Okay, so because we are lessing all distribution, we are going to take it from this. Is that okay? So when we take the total entitlement to partners from this amount, we are going to arrive at the residual profit. Is that okay? The residual profit, or the actual profit. That is this amount. I'm referring to this amount. Is that okay? Now that we are able to ascertain our residual profit, now we are going to share this residual profit among the partners, that is partner A and B, based on the profit or loss sharing ratio, the agreed profit or loss sharing ratio. So we have share of profit. Share of profit. But let's assume that the total of this is QQ. Is that okay? It's QQ. So we are going to share this residual profit. Is that okay? So between partner A and B, let's assume that their profit and loss, the agreed profit and loss sharing ratio is 1:2. 1:2. Is that okay? That is for partner A and B. So we are going to have 1/3 multiplying by the QQ, and that is going to give us an amount. And that is 2/3 of QQ. That is the residual profit, and it is also going to give us an amount. Is that okay? So this share of profit, when we add it together, is supposed to give us the residual profit of QQ. Is that okay? So basically this is how we prepare the profit and loss appropriation account. However, all this distribution or entitlement to partners will be credited to the partners account. Is that okay? Because it is an entitlement to them. Okay, and this charges against partners, because it is a charge against partners, it is going to be debited to the partners account. But it all depends on the type of account they are actually maintaining. It may be a fixed capital account or a fluctuating capital account. Okay, so let's also try to look at how we prepare the partner's current account and that of the capital account. But before that, I will explain the difference between the fixed capital account and the fluctuating capital account. Is that okay? So basically we have two types of capital accounts. So let's consider the types of capital account. Is that okay? So we have fixed and we have fluctuating. So that is fixed capital account and fluctuating capital account. Okay, I want to explain this concept before we look at how we prepare them. With the fixed capital account, the rationale behind the preparation of the fixed capital account is that at the end of the period, the balance on the fixed capital account will be the same. It won't change. For instance, when we have our capital, this is the capital account, and there is initial capital being introduced, that's the balance brought down of 1,000 cedis. We expect that at the end of the period, this 1,000 cedis should be the same. Okay, so for the fixed capital account, the balance on the capital account will not change. It will only change when there is an agreement in the partnership deed that anytime there is a capital introduced or capital withdrawal, that is the only thing that can cause the fixed capital account to change. Is that okay? The introduction of the capital may be in the form of an asset or cash, okay, and the capital withdrawal can also be the same. So in this situation, this is the only situation that can cause changes in the capital account. Is that okay? If not that, the fixed capital account, it is always fixed. And anytime we prepare the fixed capital account, so this is a fixed capital account. So anytime we are maintaining the fixed capital account, we have to prepare another account called the current account. This current account is prepared to cater for adjustment on the capital. Is that okay? I told you that in the preparation of the statement of financial position for a sole trader, when we get to finance by, we had our capital account, capital balance, we add the net profit and less drawings. But for fixed capital account, we are not going to do that adjustment over here. That adjustment is going to be done in the current account. Is that okay? So all adjustments on capital will be made in the current account. Is that okay? With the rationale that the fixed capital account balance will be fixed unless there is a capital withdrawal or introduction. However, there will be a case that you may also meet, you may be required to prepare a fluctuating capital account. With a fluctuating capital account, it is the combination of the capital account and the current account, the combination. Here, we record the initial capital contribution and all adjustments on capital will be made over here. That is why I said it is the combination of the two accounts. Is that okay? So let's try to look at the format or how we prepare the current account. Okay. So I'm still using, let's consider that we have two partners in a partnership business. That is partner A, partner B. Permit me to use the Ghana cedi as my currency. So partner A, partner B. Is that clear? With the format of the partner's current account, because of the going concern concept, we assume that the partners will have a balance brought down. They will have initial carrying amounts. Is that okay? So we have balance brought down for partner A and partner B. However, all entitlement to partners will be credited to the current account of the partners because the partnership business as a whole pays those entitlements to the individual partners, and all charges against partners will be debited to the current account of the partners. Is that okay? Because the individual partners pay those charges direct to the partnership business as a whole. However, the current account increases at the credit side, hence decreases at the debit side. It operates like that of the capital account. So another entitlement I would like to talk about is salary. If the partnership business pays salary to any of the partners, it will be credited to the current account. So we assume that only partner A enjoys the salary, but both partners can also receive a salary. If there is any interest on capital, let's say both partners, it will be credited. Maybe there is an interest on current account. If there is an interest on current account, it will be credited. Is that okay? And if there is an interest on loan, is that okay? So interest, if any of the partner give a loan to the partnership business as a loan, at the end of the period, the partnership business as a whole is going to pay the interest on the capital, the interest on the loan to that particular partner. So we assume that it is the partner B that gives loan to the partnership business. So we have interest on loan. Partner A didn't have, but both can also get an interest on loan. And if there is any, from the profit and loss appropriation account, if there is a share of profit, it will be credited to the partner's current account. So share of profit. Share of profit. That is partner A and partner B from the profit or loss appropriation account. So let's consider charges against partners. Is that okay? Or let's look at the debit side. If there is any drawings, if any of the partners withdraw, it will be debited to the partner's current account. So drawings. Let's say partner A, partner B. And if there is an interest on drawings, if the partner make drawings and there is an interest on it, the partners is going to pay the interest to the partnership business as a whole, and the individual partners account is going to reduce. Because of that, we are going to debit it. So interest on drawings. Let's say the two partners. And if there is a share of loss from the profit and loss appropriation account, it is going to reduce the individual partner's current account. So share of loss. Share of loss. So we sum it up, the total. So I'm to do the balancing. So obviously, mostly the credit side of the partner's current account is always bigger than that of the debit side. But you can arrive at a situation where the debit side will be bigger than the credit side. Is that okay? So we assume that the credit side is bigger than the debit side. We have the balance carried down. So this balance carried down will come here as balance brought down. Is that okay? Let me bring 2. So it is this balance brought down is what we are going to present in the statement of financial position as the current account balances of the individual partners. So when we go to the statement of financial position under finance by, so we have current. First of all, we come with the capital. That's the capital account balances. We have A, we have B. So the total will be here. Is that okay? So we move to the current account balances. The same A and B. This time we are going to bring these two balances. Is that okay? Do you understand? So this is how we present the finance by column for partnership business. Is that okay? So with that of the capital account balances or the capital account format, it is not anything difficult. Is that okay? So let's also consider the format of the capital account. Is that okay? So we assume A and B. A and B. Okay, so what we are saying is that when we are operating a fixed capital account, at the close of the period, there shouldn't be changes in the initial capital being introduced. So we have the balance brought down. So we expect that at the close of the period, it should be the same. There shouldn't be any changes. But if it is being included in the partnership agreement or partnership deed that there should be a capital withdrawal or capital introduction, for that case, we can actually bring it here. So we assume it is being included in the partnership agreement that there should be introduction of another capital. Is that okay? This time, let's assume that it is in the form of assets and probably cash. So the assets from A and B, and the cash to the same A and B. Is that okay? And if there is any capital withdrawal, it should be debited. Is that okay? To reduce the capital account balance. So if there is any drawings, and the drawing should be a capital withdrawal, it should be here. Is that okay? So we close the account. So let's assume that the debit side is the smaller side. So we have the balance carried down. So we have the balance brought down. So it is this balance brought down that we are going to represent under the finance by. Is that okay? So this is how the format of the capital account looks like. But this type of the capital account and the current account we've prepared is that it is the fixed capital account system. Is that okay? But in a situation where you've been asked to prepare the fluctuating capital account, what you do is that you combine the fixed capital account with the current account. Is that okay? The fixed capital account and the current account, you combine it as one account and you name it a fluctuating capital account. At the end of the period, you are going to have only one balances. So it is that balances that you are going to present, or yes, you are going to present under the finance by. Is that okay? So basically, this is how we prepare these two accounts. Is that okay? What I will encourage you to do over here is that just subscribe to the channel, turn on the notification bell, because in our next video you are going to take a full practice question where you will be required to prepare the profit or loss appropriation account, the individual current account and capital account. After that, then we prepare the statement of financial position. Is that okay? So just subscribe, turn on the notification bell so that any moment we release the video, you will get notified on your devices. Until we meet, I think bye for now.